And now it gives me great pleasure to introduce the two gentlemen who are going to kick off this session. As usual, a view from your regulator to set the stage and really outline the landscape for you. And I think probably, if I may say, maybe last year it was as important, but I can't think of a period in time when it's probably as important to hear from your regulator about where things are headed. And I'm not going to read their bios. As Grail said, you can see them, but you know them both. Gilbert Manard is Senior Director of Osfi, and Bruce Thompson says you've all known him for, was it a millennium, Bruce? He doesn't look that old. Is the Director of Osfi. I'm going to invite them both here. They're going to each speak for a few minutes, and then we'll invite your questions. I've been assured that you have many questions. If you don't, I am very happy to hog the floor, so get in there while you can. Join me now in welcoming, please, I'm not sure who wants to speak first, Gilbert or Bruce. Bruce, do you want to kick it off?
I must be, because Gilbert is sitting down. Okay. Well, good morning. And Amanda, thank you very much. And Joel and your advisory committee, thank you for inviting Osfi back once again. Osfi has been coming to the Nicc conference since 2007, the inaugural year, and we do value the opportunity to speak here a great deal. It's very important to speak to the largest gathering of insurance professionals that assembles each year. So thank you very much. In the absence of the superintendent today, Gilbert and I are going to split the areas that Julie Dixon has spoken about in previous years and hopefully add some additional color that might give some clue as to what Osfi is thinking about these days. I will speak about what we are seeing in the property and casualty environment today, what we worry about coming into the next year, and talk about some of the issues that have a particular supervisory interest to the colleagues I work with in Toronto. Gilbert will speak upon issues that are mainly of a regulatory nature, but we all know that regulatory issues turn into supervisory and to business issues down the road. But Gilbert will focus, I think, on Basel III, which of course has connotations to Solvency II, IFRS, and certain capital initiatives that are going on. So it has been customary that Osfi starts off by doing a recap about how we view the world, of what we see is going on. So let's get to that right away, and we'll do a recap of the coming year, and if I can, I'll tie that into our risk assessment of what we see in the immediate future. There were comments by Amanda talking about the financial environment that's facing the world. Of course, this is all fallout of a financial crisis, which really hit Canada probably in August of 2007. And that is a good place to take an initial recap of what is going on and what the impacts are going to be down the road. So the investment environment has changed substantially in the past couple of years, fallout of the financial crisis. Many optimists out there think that we are emerging from the financial crisis, albeit very slowly, but we are emerging. There were companies that are represented in this room and that are not here that were affected in different ways from the financial crisis than the industry as a whole. And those were companies with assets that were greatly affected by the meltdown in investor confidence and the change in investment rate. Largely, those were asset classes that were anything but perhaps Government of Canada debt or provincial debt here in Canada. And those did affect the MCT scores for companies. But the easing of monetary conditions around the world has driven interest rates to unbelievably low levels these days. Unbelievably low for persons certainly schooled in the 1970s. 5-year money that is yielding less than 2% these days was unheard of when I was learning finance at university. Expectations of lowered interest rates / investment yields first of all, affect the valuation of insurance liabilities. But similarly and conversely, they also affect the investment valuations. If your company is properly matched, that is not very injurious to your capital position. If your company is not very well matched, you all know the effects that it did to the MCT over the past 2 years. But perhaps the largest impact of the low interest rate environment is to put increasing pressure on underwriting profitability in the coming year or two down the road. The underwriting situation is under a lot of stress these days. Joel, you touched upon it. Every market that you talked about is under stress, and we wholeheartedly agree with your assessment, mainly because I think we talk to the same people and we look at the same numbers. But with the industry posting a very sensitive, and I emphasize sensitive, underwriting profit of maybe 1% from the double-digit underwriting gains that we saw only a couple of years ago. And this is making me think of the bulk of my time working with this industry when the industry never had an underwriting profit whatsoever. I think the first time we ever saw a collective underwriting profit was 2003 of all years, and it's in danger of slipping back into negative territory again. Investment yields before capital gains, of course, those were above 4% for the 6 years leading up to the financial crisis. Okay, that was roughly the same as the Government of Canada 3 to 5 year marketable bond benchmark that you can look up on the Bank of Canada's website. That averaged about 4.17% during that period. That benchmark today, or as of about a week ago when I wrote my notes, was about 1.8%. I don't think one has to be a rocket scientist to see what that implies for the reinvestment risk for all the companies. And the expectation of yield is, of course, what dictates the discount rate that the actuaries will value your insurance liabilities. The implications are extremely clear to us. Policies of accommodation for underwriters are going to cause trouble, as will lack of discipline. The consequences today, I think, are greater than they were 2, 3, 4 years ago. The investment yields are just so minuscule today that any misstep on the underwriting side is going to have ramifications much greater than what we saw a couple of years ago. I think, to be fair, though, that we do have to remember that the property and casualty industry is not the life insurance industry. The structure of products can allow companies to readjust for lower yields relatively quickly if the companies are prepared to take decisive and disciplined action going forward and not rely on the old standby of investment income. Now I think I'll turn my attention to a few specific insurance markets that we're all interested in, and we'll take a look to see how Osfi does view those markets. Since Julie Dixon stood at this podium about 12 months ago and talked about the risks prevalent in the automobile insurance markets, quite a bit has changed. Since that time, several uncertainties in the marketplace have either been clarified, hence reducing risk from our point of view, or have been significantly altered, sufficiently enough to remove prior uncertainties, but inevitably introducing new unknowns. But perhaps these are more manageable unknowns. Important judicial decisions occurred over the past 12 months, starting with the decision of the Supreme Court of Canada to dismiss the leave of appeal from Alberta about the minor injury regulations. A similar decision, I think, in May, when the Supreme Court of Canada chose not to hear the appeal on the Nova Scotia situation. That has removed a lot of uncertainty, and from a supervisor's point of view, less certainty equates to less risk. But if we turn our attention to the automobile situation in Ontario, the euphemistic elephant in the room, as we all know, significant events have culminated in the past couple of weeks that Joel did talk about. The Ontario government has initiated and has implemented substantive reform measures following upon detailed advice received from Fisco. The intent of the Government of Ontario, and this is not an advertisement, but the intent of the government was to provide more choice for consumers, to limit excess assessment costs, all in order to make sure that there were more dollars available to actual accident victims. At the same time, stabilize insurance premiums for the consumer. And I don't think anyone in this room could not consider those to be laudable goals. Time, of course, will tell about the efficacy of the reforms. Are they going to work? I think we all have our fingers crossed. The introduction of the Ontario reforms, as compared to the last major overhaul in 2003, I believe that was Bill 5, is being met with very, very different expectations this time around. In 2003, the average premium dropped by 10% prior to the implementation of the reforms, and with a further gradual reduction of 3 or 4% in the months and the quarters that followed the introduction. 2010 is different. 2010 is very different. The reforms are being met with unabashed caution by the industry. No one is jumping out with very significant rate decreases. The average in April, I believe, with the fiscal applications were about a decline of 1%. Certainly in line with the Government of Ontario's intention for premium stabilization, but the future will tell whether the reforms truly are successful down the road. The industry has responded with caution. Caution is good. Osfi values prudence. We certainly value caution. It will be some months before a sense of the effects of the reforms are felt, and many, many months before the full extent of the claim savings, if indeed they persist, if they can be accurately gauged. We will find out down the road if minor claims are being settled within the $3,500 cap. We will find out whether the verbal threshold is being challenged. We will find out if there is creep or leakage of claims that aren't minor but aren't catastrophic are finding their way into the catastrophic category. We're all in a period of uncertainty, and uncertainty to us implies risk, albeit a very, very different risk of knowingly underpricing a product that I believe that we were seeing. If early indications do show that pricing levels are not commensurate with claims emergence in the coming months and quarters, then we expect companies to be very proactive with their regulator, with their rate approval regulator, not to fall behind in the pricing calculus. All too easy to fall behind and wait. I think Julie mentioned a year ago that hope is not a risk mitigant. It's important to stay ahead of the pricing calculus to make sure that the industry is not playing catch-up. To move away from automobile and the other vital areas of insurance, let's look at the property line, the homeowner's line of business. This time last year, that product line was looking rather bleak. It seemed that a combination of bad weather events and the acknowledged issue of insurance to value, or that whole proposition, were combining to drive relative claims experience to a level that really hadn't been seen in 15 years. The line, which was the proverbial cash cow for the industry, had truly become unprofitable. Something happened in 2010. Something happened that was essentially very good news. Some of it might have been fortuitous, but on the other hand, some of it was a direct result of concerted effort by underwriters in companies across the industry. Pricing action was taken, and this was across the board. It was sufficient to at least partially rectify the undervaluation of construction contents and the damage caused by water and the repair of that damage. Additionally, the weather in the first half of 2010, for some reason, inexplicably, has been very, very mild. The turnaround in fortunes in this line of business, homeowners business, as far as we can determine, has hit the bottom line extremely beneficially. We believe the turnaround from the first half of 2010 compared to 2009 has shown an improvement of about $500 million. Well, congratulations. That was for the first half of 2010, and we think about 2/5 of that $500 million improvement is directly attributable to price strengthening, something which had to take place, and maybe 3/5 at this stage was a reduction in loss activity, which we think was mainly attributable to improved weather conditions. Again, Osfi correlates risk with uncertainty, So concrete steps that have been taken by underwriters and will continue to be taken by underwriters, all those will continue to help fix the pricing imbalance and lower Osfi's overall assessment of risk. But short-term improvement in weather conditions will not lull anyone into a sense of complacency. And Joel, you talked about what happened just after the second quarter concluded, first and second week of July, the storms in Calgary, Saskatchewan, Ontario. I'd written down that the cumulative cost might be $400 million. You've updated that to $600 million. And if the rest of the year holds true to form, we dodged the Hurricane Earl off Halifax a week or two ago. But if the remainder of the year holds true to form, with the losses that we know in July, the industry's underwriting profit of a very sensitive 1%, that is in jeopardy. That 1% profit has been wiped out as of July. So hopefully the summer has progressed and it can be rebuilt again. But the industry certainly is in danger of sinking into the red. I'd like to touch upon commercial lines because it is an area which is harder to measure than personal lines because it is not a very homogeneous product, and it is hard to measure, very similar trends as one can in auto or homeowners. But market conditions have been very, very soft for a number of years, with representative premiums not even keeping pace with inflation since 2004, let alone any allowance for general economic or business growth. But loss experience, on average, has not reflected the softening picture for several years, and the expected deterioration in results had been somewhat absent until a year or two ago. Individual company results, of course, they vary quite a bit, but if I talk in generalities of the industry, the overall picture in the last 2+ years, of course, started showing signs of significant deterioration, and there is the thought out there that there is adverse development potential built into the reserves. But there has been deterioration to a degree that our assessment is that these business lines collectively can no longer be viewed as being even marginally profitable. Some underwriters I speak to, they talk to me about the good luck the industry, the commercial lines underwriters have been experienced for several years. But then, being in similar business as Joel, similar. I don't believe in luck in the long term. I place stock in statistical variances, definitely, but I don't believe in luck. And the statistical variances suggest to me that the collective dodging of the bullet must inevitably come to an end, and it might come to an end sooner rather than later. So, to sum up quickly, the risk assessment that Osfi has on the major business lines that are represented by people in this room. Automobile other than Ontario, yes, there are developments in other provinces, but certainly our overall uncertainty, hence risk, has been lessened because of the decisions of the Supreme Court. But of course, there are other challenges, but our risk assessment has gone down. And that's a good thing, There have to be some good events that are happening to the industry. Ontario. The reforms provide an opportunity for the industry to catch its breath and to once again stop playing catch-up. There was a lot of catch-up playing over the last year. It is absolutely critical not to let rate adequacy slip away, and should loss emergence in the coming months prove to be disappointing, we do expect companies to be proactive. So our assessment is that, risk has lessened moderately, only moderately, and is on hold for the time being until the analysts, the industry, Osfi, have a proper time frame to sit back and assess what is the change in behaviors that the Ontario reforms have affected. Homeowners, significant steps have been taken to rebalance the pricing and risk equation. The unknown continues to be weather, of course, and no one is going to stand here and predict what is going on there. Our outcome, or our prediction of the outcome, of course, does reflect positive underwriting decisions that have been made, and we expect them to continue to be made, but we do remain cautious. Commercial lines, unfortunately, results are deteriorating after several years of sluggish, at best sluggish, rate activity, and our outlook will remain pessimistic until markets are able to demonstrate more than sporadic or anecdotal rate taking. So we hear from companies what they're doing, but every time we speak with other companies, we hear stories that somewhat counterbalance that message. So until we see activity which can be demonstrated in statistical numbers, I think we're going to sit back and be very, very concerned about what the future might hold. Okay. And quickly, I am probably going over my time. I would like to talk about a few of the communications that Osfi has issued in the past year. These communications were in the form of guidance that have been issued to the industry, and they involve stress testing, capital targets, sound reinsurance practices. I am going to let Gilbert talk about the capital targets. I think he's more of a position to describe the intent of that. Some feedback that we have received from all this additional guidance, or the setting out of expectations, continues to place an increasing level of burden on senior management of boards, and while responses from other parties tell us that these enunciated expectations are in line with good practices that are already exhibited by many companies. So we have two stories. Is Osfi being overbearing with our expectations, or is Osfi talking about risk management practices that are really in effect with many companies? Stress testing. The stress testing guideline is clearly putting the onus on boards, management. And when I talk about boards, in terms of foreign companies, I am talking about the chief agents and the independent oversight functions that exist in their home offices. The responsibility of governance as a whole to build a risk management infrastructure that monitors the known, monitors the unknown if that is possible, look for correlations and combinations of risks that are facing individual companies, and to look at situations which are very, very damaging. Okay. The board does bear the ultimate responsibility for the stress testing environment, and senior management, of course, is responsible for the design, the implementation, and the management. Capital targets, again, I'll defer to Gilbert. So I'll move to reinsurance. The draft guideline followed several years of discussion with the industry, a lot of years, maybe too many. The guideline recognizes the critical nature of reinsurance as a risk management tool and the need for a reinsurance risk management plan to be overseen, board, senior management, of course, with that plan identifying the objectives of the reinsurance program, including risk diversification, risk concentration, capital management, controlling reinsurance risks. The guideline also reiterates numerous practices of good management that Osfi has stressed for many, many years, including proper counterparty assessment and the need for timeliness and clarity of all reinsurance contract documentation, and the need for clearly worded insolvency clauses. Okay. A common theme, throughout those two guidelines I talked about, and it's also in the capital guideline, the common theme of these guidelines is actually nothing that is startlingly new. Stress testing, capital management requirements, good reinsurance practices are not new concepts that are all of a sudden necessary for the safe and sound functioning of financial institutions. Osfi is largely, seeking to clarify its expectations of government's functions. Clarify, but not set new standards. Each of these guidelines does make reference that the infrastructure or process should be in place for individual companies, but it should take into account the nature and complexity of the company and its risk profile. In other words, proportionality, the very same concept which applies to how Osfi should be doing its work as well. Osfi issued its General Corporate Governance Guideline in 2003. Now, that's really quite a long period ago. These new guidelines reinforce the concepts that were laid out in the 2003 document. Specifically, one point being, institutions will adopt different approaches, taking into account different nature, scope, complexity, and risk profile. And the other point being, risk management systems will differ depending on the scope and size of the institution and the nature of risk exposures. So if I go back to my comment I made in the few words to preface this section, if there is a perception that that expectations are increasing disproportionately for boards and management of smaller, less complex companies. That is not the intent of what we're trying to do, but I would urge you to, discuss these issues, discuss them with your relationship manager, and then develop an appropriate action plan that will address any major gaps. I thought about talking about the work that we are doing on the earthquake guideline, which is 12 years old, but I don't think I'm going to have enough time for that today. This is an opportunity to have a plug for all the companies in the room. Osfi is hosting its second risk management seminar in early November. I believe every company will receive an invitation via email imminently, and this is something which I believe might be on the agenda because the work we're doing on earthquake, the guideline is 12 years old. It's extremely critical. The Government of Canada recognizes how important the earthquake preparedness, that means this business as well, is terribly important to all facets of our society. And after 12 years of having an existing guideline, it's time that we do sit down with the industry. And we are fortunate that we have reinstituted a working group that is facilitated by the Insurance Bureau of Canada. The Insurance Bureau is acting as co-chair of this working group, and we do have participants from the insurance industry, reinsurance intermediaries, and from the ICLR and from the AMF. So I think we're very well represented, but this is work that's very early on, and we hope to be able to report back to you in early 2011. So quickly, before I take up all of Gilbert's time, to sum up the few messages that I wish to deliver today. One, underwriting discipline is, we say this every year, underwriting discipline is critical, but maybe at no other time more critical than now, with the investment environment slipping back to a risk rate free of, got that wrong. The interest rate environment is so depressed right now, investment income will not bail out companies that do not exercise discipline. The Ontario automobile situation, we're prepared to sit back and wait, but not for too long. We have to get an assessment of the efficacy of the reforms, and every company represented here should be doing the very same thing, as I'm sure you are. And the recent guidelines that have been implemented by Osfi in the form of risk management are designed to reiterate our expectations, not necessarily introduce new expectations for improvement in risk management. So, Joel, thank you very much for the invitation, and if we can get Gilbert, thank you.
Thank you, and Bruce, next time I'll go first. So, good morning, and thank you for the opportunity to speak today. Thank you, Joel, and the organizing committee. The past 3 years have been anything but boring. And on the regulatory front, they've been among the busiest and the most challenging in recent memory. And as Amanda said, it's not over. We're not out of the difficulties in terms of the economy. And on the regulatory side, there's still a lot to be done to actually upgrade and update our regulatory framework. So what I want to do today in the next, I'll say 15 to 20, but probably 15 minutes, is to look forward. I don't want to go back on the past and go over the past 2 or 3 years, but look at the broad avenues that are lying ahead for your industry. And also look at some, if I have time, actually, I can skip that, but if I have time, also look at some of the files that we have on the go now, shorter-term files that we're looking at for your industry. And specifically, Bruce has mentioned it, but what I want to look at is, or comment on, is the impact on the P&C industry of the Basel changes that you've heard on the banking side. IFRS, what impact it will have on us at Osfi, on the framework, but on you as well. Also the movement to harmonize the international capital regulatory requirements for the insurance industry. We're taking an active part in that, and I just want to tell you a little bit where it's headed. Joel has mentioned the move to internal models for our own regulation, but it's not only internal models, it's also revamp standardized approach that takes more risk risk-based approach, a better risk-based approach. And that's under the, I guess you're familiar with the P&C Advisory Committee, so we're working with the industry on that. I'll mention the recent guidance on capital targets, and as I said, if I have time, I'll mention also some of the ongoing initiatives specific to your industry on the capital required side. So the first thing I want to talk about is Basel III. So who's this guy coming here at this P&C conference, and the first thing he talks to us about is the banking industry. But as you know, Osfi is an integrated regulator. We do want and we do strive to actually, if you want, permeate the best practices in all the sectors to one another. And obviously, a lot of the action in the past couple of years was to try to address the deficiencies on the banking side and to learn from the crisis and to introduce the changes that will never alleviate all the risk of crisis, but at least address the issues that we've learned and maybe be a bit more imaginative about the risks that are out there. So you've seen, I mean, the past, I guess 2 weeks ago, there was a press release from the Basel Committee. Back in December was a paper, in July as well. And actually, as I speak today, the Basel Committee is meeting in Switzerland right now, and they're going over a lot of the things that have not been finally, I guess, nailed down yet. But what we know is basically things will be done on the banking side to address things like liquidity, have internationally agreed liquidity requirements. A lot of people, correctly so, point to the liquidity deficiencies to be a great contributor to the crisis. So there will be liquidity requirements. There will be basic, simple, good old leverage constraints. We had that in Canada for I don't even know how many years, and it's been a very useful tool to really act as a backstop to all these risk measures that we collectively want to be as precise as possible, but we know we will not get it right all the time, neither the companies nor the regulators. So basic, good old, simple leverage ratio as a backstop. And it's been recognized by the international community, which is a good thing. Another very key and very important factor that will be addressed is the better measurement of risk, and especially things like on securitization, on the counterparty credit risk, on the interconnectedness of the financial sector. So there are also key developments on that front. The one I'd like to just focus on for 2 minutes is the one probably that is the one that is most talked about. It's the capital requirements. So in a nutshell, what will Basel III do on the capital requirements, and what will be the impact on your industry, the P&C industry? I mean, to summarize very simply, more capital, that's what will be required. If you've seen a couple of weeks ago, if you count the buffer, it's about 7% versus what of tangible common equity versus 2 before, so more capital. A much greater proportion of the highest quality capital, common equity. Fewer exotic instruments, hybrid instruments, we call them innovative in Canada. Fewer tiers of capital, used to be Tier 1, Tier 2A, Tier 2B, no more Tier 2A, Tier 2B. And also more deductions from capital to reflect things that don't really have the quality of capital. So I'm sure a lot of you must wonder if I'm describing the future capital requirements of the banking industry or the current capital requirement for the P&C industry. And you'd be right. Actually, a lot of these things will probably bring the capital structure of the banking sector closer to what you already have in the P&C insurance sector. You don't have tier capital, so let's leave alone fewer tiers. There's no innovative instruments in the P&C industry. Your capital structure is composed mainly of common equity. So this is one thing, and again, we have to go through the whole rule book, and I cannot tell you right now that there will not be consequences or, as I say, migration of best practices to the P&C industry. But at least on the definition of capital, the P&C industry is probably a good way there right now because it has a much more, a simpler, more solid capital structure. So again, not a promise that there won't be any changes, but at least on these aspects, probably a fewer changes to expect than in other industries, for example, the life industry. So turning now to the second subject, IFRS. As you know, it's coming. And I would like to focus just a few remarks, especially on IFRS Phase 2, which focuses especially the insurance industry. And obviously, I mean, it's a key consideration for you. Your financial statements are based on the accounting standards, but also for us as regulators, because actually it's the building block of our regulation. We do rely on the accounting profession, we do rely on the actuarial profession, and then we do our rules knowing that we have this input from the professions. And sometimes when we have to, we do actually use it or correct it if you want. And therefore we have to know exactly what the impact of changes to in that case, the reporting standards will be. In particular, under IFRS Phase 2, it's proposed that all insurance liability will be calculated at a discounted value, which is already a Canadian practice, but the difference is that the discounting factor will be an interest-free rate, which is different from the current Canadian practice. We have heard quite a bit from the life insurers that they have concerns that this approach will create a lot of volatility in the statements, and also could, as I said, we rely on the accounting numbers to have the regulatory requirements, could result in wide swings as well in capital positions. The International Accounting Standards Board is still consulting on their exposure draft, so it's too early for us to say exactly where we'll be headed. But one thing for sure is we want to hear from the industries, and actually your industry, because we've not heard a whole lot up to this point about the impact of IFRS on your industry. So we want to have that on board. We have, which is not my group, but we also have at Osfi an accounting group that is involved in these discussions with the accounting standards boards. So they need your input to actually have these discussions. And when it will get to the impact on the capital requirements, we will need to interact with all the industries to figure out if there are things that need to be done on our side. So let me now move to the third topic, the convergence, the international convergence of insurance requirement. The International Association of Insurance Supervisors, the IAIS, is advocating better convergence to various jurisdictions' regulatory requirement. They are embarked right now in an exercise to develop a common assessment framework for insurers. And let me be clear, it's not a common set of rules or a common test, but a common framework for assessment. So basically, broad principles and broad directions. Osfi is very, very actively involved in that process. We believe it's extremely important for two reasons mainly. First of all, we don't have all the answers ourselves, so we do participate in these fora to actually exchange and get the best practices from other countries. So we do it nationally, but we do it internationally as well. But equally important, we want to make sure that our financial industry operates in a competitive context internationally. So as is the case on the banking, the life insurance, and the P&C, we want to have a broad direction and a broad framework that is aligned internationally. Because what we hear probably most often, and before being at Osfi, actually, I was for a long time in the Department of Finance doing tax policy for the financial sector. And it's the same type of message. Okay, we understand what you're trying to get at, but please make sure that we are in a competitive position. So you're there to either ensure the protection of policyholders and depositors, or to raise money for public funds. We understand these objectives and we will participate, but don't treat us vastly differently than others. I mean, we need to be alive and to be protecting policyholders. To be protecting policyholders, we have to be alive, and to be alive, we have to be competitive. So our participation in these international fora is our way to promote these internationally agreed standards so that your industry and your companies can operate in a competitive environment. The move that we have at Osfi to go to internal-based models, and that's done through the, as I said, the MAC Advisory Committee, the Minimum Capital Advisory Committee. This work has been really pushed for by the industry. Some companies are already using internal model-based approaches. Other industries are also moving in that direction. The banking is there, the life industry is moving there, and we actually have the same process for the P&C industry. It's a medium-term process. We don't have the resources to do a big bang approach, which is a little bit what Solvency II attempts to do, but it creates its own problems. So we go at it risk by risk. But it's not only, and referring again to the comments from Joel, what's in it for us in a sense, we're not only developing an approach for companies that have the resources to do internal models, we're also modernizing the MCT test, which will be the standardized approach. So we want to make it more risk responsive, improve it. So actually it's a better test. So we have the two processes in parallel. We also, I want to stress that the main objective of that is actually to promote and to encourage better risk management at the companies. Your companies, the banks, the life insurers, it's the same thing. So when we develop or will implement these procedures, one of the key elements will be the use test. You don't do these things or these internal models just to file with Osfi. It will be to the models with some guidance that you will be using in making your decisions and to do the risk management in your company. So for us, actually, it is the key parameters is to promote the use of better risk management practices in company. What's in it for us? I think I'll answer it because I'm sure it's going to be a question. We take a very similar approach when we move to fixed rules, simpler rules, to more flexibility for companies. So it costs a lot of money and all that. And as I say, it's good incentive, so it's good for you, should do it anyway. But what's in it for us, is it worth the investment? And obviously, I'll put the stage, obviously, when you move from one system to the other, we're very, regulators are absolutely the most risk adverse, even more than you are. So we don't want to put all our eggs in one basket. So we don't like wide swings of capital when we change systems. So initially, that's the expectation. But yes, over time, generally, when you have two sets of models, a standardized, simpler one that you can refer to and have a little less cost to invest in and maintain, generally the standardized results in a slightly higher capital requirement. But as I said, even an internal-based model, initially for sure, we don't like big swings, so it remains close. And it evolves as the companies and the regulator become more comfortable with what's generated by the new method, more flexible method, then we find the right zone. So yes, there will be something in, but not on day one, that's for sure. We're not so foolish to think that we will get things right off the bat, and we're not even foolish to think that we get it right at any time. We just improve it all the time. So we're learning from the crisis, and we know there'll be others, and we'll keep on learning. Maybe I can go for another 2 or 3. Capital targets, Bruce has mentioned it. We had several questions coming from the industry, so we issued this a draft guideline in May of this year, entitled Capital Targets Federally Regulated Insurance Companies, which now applies to both life and P&C companies. So the target we set, which is the supervisory target, is at 150%. But we also, and give a lot of, guidance or directions for companies to set their own internal targets. 2 reasons for that. The test doesn't cover all the risks. Second reason, you know your risk better than we do. So you have to set your own internal targets in discussions with your supervisor to a level that corresponds to the risk profile of your company. And obviously, the capital position is used by supervisors as an important piece of information to assess the financial condition and ongoing risk profile of the company. So I'll say a few words about the I guess, the ongoing capital initiatives we have, so that give you an update on where we are. So these initiatives are on the capital required, so what we required as capital, so I guess the denominator of the test. Claim liabilities. We had representations from the industry that because we based our capital risk weight on the liabilities, and liabilities use some safety factor, the provision for adverse deviation, there was a concern that if companies are more prudent by putting some factor for the unexpected in their liabilities, that resulted in more capital, so sort of a double whammy. So we recognize that, and we will be moving to basing the capital risk weights on the best estimate without the PFAD. That's one thing. The collateral, P&C companies have been able to reduce their liability transfer to unregistered insurance as long as they had acceptable collateral from the reinsurer. So what we'll do from now on, and in passing I mentioned that in particular letters of credit, that as we increase that from 15 to 30% in 2010. So what we'll do, and I guess the give and take, if you want, is we'll move to have a risk weight that applies to the collateral, and that's a treatment that is totally aligned with life insurers and banks. So that's the second thing I wanted to mention. The asset credit risk. We also want there to do a bit of harmonization with the life industry, and actually this one should be positive for the P&C industry, generally reducing in lower capital requirement because yours were a bit higher. And we also refined the risk categories for the assets so that we better match the risk, better match the maturity of the security, therefore better calculate the risk. And the last I'll mention is the interest rate asset liability mismatch. So we have, as you know, we have a data call out there to assess because when interest rates move, like affects your assets and liabilities, we don't have any requirement on the capital side to take into account the risk created by the mismatch. We've asked for data on that and other things. The first look we had at that, actually the mismatch is a bit bigger than we thought. So we will continue to work on that and interact with the industry to figure out how to take that into account. So that's, I guess, the broad picture I wanted to give you of the coming months and coming years and the big avenues. So again, thank you very much for the opportunity to present that to you today, and we will continue, as we've done in the past, to work with the industry to ensure that the capital framework is safe and sound and up to date. So I guess Bruce and I will now be fielding the questions.
Thank you very much to both of you. We have a few minutes for questions. There are microphones in the room. If you want to put your hand up, I don't want to take questions if you've got them, because we do have a limited time before we want to get you to a break. So can I see any hands out there? Anybody who's got a question right now? It's going to be better than mine. Going. We may only have time for 2 or 3. I guess, Gilbert, one thing I would ask you is, one of the things that was apparent out of Basel III was that when we write recommendations, even nationally, let alone internationally, you do have to kind of write to the lowest common denominator, in Basel III's case, the European banks. What's the effect of that in the insurance industry? How does Canada rank internationally as we look at changing regulations relative to other nations?
If I may just comment on the Basel III and lowest common denominator, it's kind of interesting because actually it's true, and what happens is that those that had probably the lowest common denominator, the countries, are now like, the calibration of Basel is very difficult these days because it seems to be calibrated to the lowest common denominator, which means that the requirements are quite high, and there's sort of a fear that Osfi has been historically more prudent, maybe, than other regulators. So will we add a layer to that? And we find ourselves in the odd position of actually arguing reason almost internationally. Say, look, we have industries, we know there are problems, but as I said before, if we want to protect the depositors, the policyholders, we still have to have an industry. On the insurance side, it's not yet to that level of commonality, But when we get exercise, as I mentioned, like Solvency II, and I didn't mention there's also, I forget, they have a name for it in the US as well, where they're modernized. We certainly monitor that and follow that. But they're not starting from the same point. It is probably we had harmonization before on the banking side. We don't have it on the insurance side. And I think the insurance regulation in Canada is not, it needs to be improved and all that, but it's not that bad compared to the starting point in some other countries. So Solvency II, for example, is making a big jump, and it's a big bang approach. Well, we probably don't think that it's that much of a big jump to make here. We can build on what we have. And as I say, we go piece by piece. So it is a big factor on the banking side. On the insurance side, the landscape is slightly different. So I think there will still be for a number of years guidance, but not to the point where we'll be stuck to follow others. And we're not committed necessarily to we'll go the way Solvency II goes exactly. We monitor it, but we'll make our own decisions.
Any questions out there? Yep, way at the back. Got the microphone.
Thank you. This question is for Bruce, who, as we all know, knows a little bit about reinsurance. We'd be interested in your educated guess, I'll emphasize guess, on where increased risk management and governance on reinsurance will take us. Do you think it will bring about increased use of international reinsurance which is not licensed in Canada? Do you think it will lead perhaps to an alternative risk coverage of insurance-linked securities? Or do you think other things? I'd be very interested in your comments on that.
I'm not exactly sure if I got all that, but the question on the reinsurance front, risk management, decisions that companies will make in terms of the markets that they choose to purchase reinsurance from. Do we think that there'll be a wholesale change in buyer preferences because there will no longer be the limitation 25% on the unregistered market? I think the purchasers of reinsurance have spoken very loudly that they have a strong preference to purchase their products from companies transacting business within Canada. And certain markets aside, being catastrophic reinsurance. So I don't know if there are other elements in the question that I didn't quite hear properly, but I do not expect wholesale changes in behavior, most definitely not.
Okay. Any other questions? Okay. Well, as we wrap to break, I guess I would ask, and this is possibly at a higher level, less granular, more stupid, if you will, a journalist question, than some of you may have. These gentlemen may be around in the networking break, so if you've got the more granular questions, maybe you can buttonhole them there. But just briefly from each of you, I mean, you both identified some of the big challenges. We don't have a lot of time, but I mean, just for instance, Gilbert, I think you both actually talked about the mismatch, the interest rate asset liability mismatch. Would you identify that as the single biggest risk facing this industry right now? And if not, is there another one that you would say is the bigger risk?
I won't rank them, so single biggest. But there is, it is probably, and correct me if I'm wrong, but the interest rate risk is probably very high on the life side because of the land. P&C, I mean,
Lower.
Much lower, but maybe that's what you have in mind. It is right now quite a big risk on the life insurance side, as was in a few months back. I mean, it still is the equity risk, but now it adds up. Like the interest rate environment is very low, and there are long-term liabilities, long-term guarantees, and these low rates were not factored in necessarily in the projection. So it's unusual economic times, and it's the longer the liabilities are, the greater the risk is.
So if not that in P&C, Bruce, what would you say is the biggest risk right now?
I would say that the industry is cognizant of how risky their business is on the underwriting side. The liabilities are very uncertain. The industry, by and large, has been very, very conservative in their selection of investments to match those liabilities within certain areas of latitude, whether the selection of asset classes, but by and large, the duration being short, there's not a huge timing mismatch. Definitely not exposed like the life insurance business is and what we're hearing in the press. It's not the biggest risk that this industry faces. Ultimate yield is a big issue.
Okay. With that, I think we're at time, so we're going to wrap this session. Please join me in a warm thank you to Gilbert Ménard, Senior Director at Osfi, and Bruce Thompson, Director at Osfi. As we go to break, it's a good opportunity to remind you that all of the breaks and some of the events are sponsored, and I just wanted to take this opportunity to ask you to join me in thanking those sponsors. For those of you who enjoyed last night's cocktails, and even for those of you who didn't enjoy them, they were brought to you by Lloyd's, so please join me in thanking Lloyd's for that. And this morning's breakfast was brought to you by Riverfront Medical Services, so our thanks to Riverfront. And as you go to this break, I'll just remind you, you have until 10:45. We asked you to be reasonably prompt because you're a big group and we do want to get things moving on time and finish them on time. You'll find yourself for the break just down the escalators on the 9th floor in front of the fortifications room, which, and don't mispronounce that, folks, which is conveniently where you will find the next session. And this break, incidentally, is sponsored for you by Duck Creek Technologies. So in advance of the break, our thanks to Duck Creek. We'll see you at 10:45.